Hi everyone and welcome back to my channel. I'm Lorenzo and here we talk about the stock market, analyze businesses and look for investment opportunities. Today, for the first time, we're diving into one of my favorite asset classes, commodities. In this video, I'll talk about a company whose share price is heavily influenced by the price of the commodity it produces. If you enjoy this kind of content, let me know in the comments and of course, don't forget to subscribe. To explore this idea, we're starting with VALE, a Brazilian mining giant primarily focused on the iron ore business. We'll look at how VALE's share price is directly connected to iron ore prices, and that's why it makes sense to start by analyzing the iron ore price trend over the past few years. There was a significant spike in iron ore prices following the reopening of economies after COVID shutdowns. This caused major supply disruptions and inflationary pressure, pushing prices higher. Like every commodity-related company, VALE is highly cyclical, and in these types of investments, your entry point matters a lot if you want to generate strong returns. As you can see here, the two graphs, VALE's stock and iron ore prices look almost identical. Let's take a look at VALE's latest earnings presentation. Of course, it highlights the positive aspects, like any good investor relations document. Right at the start, they emphasize the long-term strategy, VALE 2030, with words like superior portfolio, trusted partner, performance-driven, and so on. They report a 4% increase in iron ore sales, despite a 4% drop in production. Then there's a slide about improved safety and efficiency. And this is actually a signal that times are tough for the company. Why? Because in bullish markets, companies focus on growth metrics like production and sales, but during more difficult periods, they highlight cost control and efficiency. This is usually a good sign for contrarian investors. It can even be interpreted as a buy signal. They also mention an 11% increase in copper and nickel production, but we know that those two segments represent only a small portion of VALE's total revenue. Since iron ore is VALE's core business, making up around 80% of total revenues, the company's valuation is essentially tied to iron ore prices. This is also confirmed by comments from VALE's executives during the Q&A session of the latest earnings call, where they clearly stated that China is the most important geography for VALE's future. Now let's look at some numbers. We can see that net operating revenue decreased by 4% in Q1 2025 compared to Q1 2024. Even more notably, revenue dropped by 20% compared to Q4 2024. Now, this is important. In cyclical businesses, especially those tied to commodities, we want to see bad numbers. That's often when it's worth starting to build a position. When things look great, the upside is usually limited, but when things are tough, like now, the risk-reward starts to look more attractive. On top of that, adjusted EBITDA decreased even more than revenue, down 9% year over year. This tells us that margins are shrinking, not just revenues. In fact, excluding the massive spike in iron ore prices, VALE's revenue has remained relatively stable, around 200 billion Brazilian reals. What changes dramatically is the net profit, depending on iron ore prices. The higher the price, the higher the margins. We also see a huge 77% drop in free cash flow year over year, and a 16% increase in gross debt, along with a 22% increase in net debt. This is mostly explained by the large dividends paid. That's why it wouldn't be surprising to see VALE's 8% dividend yield come down, and frankly, that could be a good thing. Even cutting it to 4% would still be attractive while preserving more cash. At first glance, these numbers might seem worrying, but for investors looking for cyclical opportunities, this could be the perfect setup. These kinds of investments aren't meant for short-term traders. You need a medium to long-term mindset, ideally 3-4 years, to really benefit from the cycle. We can never know exactly when the turnaround will happen, but when it does, those who entered earlier are usually well rewarded. There are also some short-term factors that could be bullish, like the weakening US dollar, which often benefits emerging markets. These markets tend to thrive in this kind of environment, and so do commodity stocks. Now let's talk about something really interesting, the global iron cost curve, from a report by the Reserve Bank of Australia. This kind of curve ranks iron ore producers based on their average production costs, from the lowest cost producers to the highest. On the low cost end, we have Australia and Brazil, companies like VALE, BHP and Rio Tinto. At the high cost end, we have China. Why? There are two main reasons: lower ore quality, which means more processing is required, and high domestic transport costs, since mines are far from steel mills. At a spot price of around $80 per ton, VALE and other Brazilian Australian producers are still profitable, while many Chinese producers are already unprofitable. So when prices fall, the high-cost producers suffer first. Low-cost producers like VALE can keep making money, even in downturns. Now let's talk about a key indicator for commodity companies: inventory. As with any commodity, prices are driven by supply and demand. By looking at VALE's inventory data, we can get a clearer picture of what's happening. We notice that inventory has been decreasing over the last few quarters, and that could be a good sign. But we need to understand why. Why might inventory be falling? There are several reasons. Strong demand: if they're selling more iron ore, that's bullish. Production issues: if output is down due to maintenance or regulations, that's neutral or slightly negative. Weak future demand: if they're cutting inventory in anticipation of slowing demand, for example from China, that's bearish. So, falling inventory is bullish only if demand is strong or supply is constrained. What's the impact on iron ore prices? If demand is strong and inventory is low, prices could rise. If production is low, supply tightens, prices could also rise, at least short term. But if demand is weak, falling inventory might just reflect less buying, and that's negative. Same logic applies to the stock price. If inventory is falling due to strong sales, that's positive for revenue and profits. If it's due to production issues or weakening demand, that's a warning sign. So, to conclude, I'm quite confident in VALE. It's a solid business with strong leadership in the iron ore space, no major red flags in terms of operations, but like all cyclical companies, timing is uncertain. The turnaround might take longer than expected, and patience is key. Remember, VALE's performance is heavily linked to China, and in recent years, and possibly the next, China's property and infrastructure sectors are still struggling. A real recovery in VALE's fundamentals might require strong stimulus from the Chinese government, particularly from Xi Jinping's administration. So, VALE is not a stock for everyone, it's for investors who are comfortable waiting and possibly averaging down if the stock drops to $6–7 per share, for example. But if that happens, and you're positioned well, you might enjoy the full upside when the cycle finally turns. Because sooner or later it will. Thanks for taking the time to watch the video. If you liked it, don't forget to click the like button, subscribe to the channel and hit the bell so you won't miss the next ones. See you soon!